Digi Power X Inc., ticker DGXX Q2 2026. So they completely missed consensus estimates across the board. I mean, earnings per share came in at a loss of 17 cents, which that widely misses the 7-cent loss estimate. That's a 142% miss.
Yeah, and the revenue side wasn't any prettier.
Right. Quarterly revenue was $6.63 million, just completely missing the Wall Street consensus range. That was supposed to be between $8.75 million and $12.04 million.
But then you look at guidance, and management is guiding Q3 revenue to increase by over 100% sequentially. They're actually targeting a $250 to $300 million annualized revenue run rate by Q3 2027.
Exactly. But obviously the stock reacted really poorly to the headline miss, and that widened GAAP net loss of $14.4 million. During the August 14th session, DGXX dropped 3.87% to close at $3.97.
Oh, thank you.
Yeah. Trading volume was exceptionally heavy, like 32.7 times the average. It actually hit an intraday trough of negative 17.2%.
So those are the hard numbers. You just read the financial headlines this morning. You'd absolutely think this company was falling apart.
Oh, 100%. But when you start looking through the actual filings, the reality is entirely different.
Right, which is why we're doing this deep dive for you today. Our goal is to really cut through the immediate noise of that top-line miss and unpack the underlying details.
Yeah, we need to look at segment performance, margins, management's commentary, and of course, the notable risks.
Because we have to understand the ultimate Wall Street paradox right now.
Yeah.
Like how a company with a $6.6 million quarter is simultaneously touting a $1.1 billion contracted revenue pipeline.
Okay, so let's unpack this because, a massive revenue miss usually means a company is bleeding customers.
Usually, yeah.
But when you look at the segment-by-segment breakdown here, this actually looks like a very intentional business pivot.
Yeah.
We need to understand why total revenue shrank from $8.1 million a year ago down to $6.6 million today.
Right.
Like, where is that $6.6 million actually coming from?
Well, that's the exact right question to ask. If we break down that $6.6 million figure, we see two really distinct sides of the business. First, $3.6 million came from their legacy co-location and crypto gaming operations.
Okay.
And then another $1.9 million came from energy sales. Now, both of those numbers are down, but they represent a deliberate, planned wind down.
Meaning management is intentionally scaling those legacy operations back.
Exactly. But the crucial highlight, the number that completely recontextualizes this entire quarter, is the $1.1 million that came from their NeoClouds platform.
And that $1.1 million is specifically from GPU bare metal rentals, right? Which represents their very first artificial intelligence compute revenue.
It does, yeah.
So for you listening, trying to visualize this, what does a bare metal rental actually look like operationally?
In the simplest terms, it means providing the raw, dedicated hardware directly to a client. In this case, we're talking about highly sought-after AI chips, specifically NVIDIA GPUs.
Right, so no cloud layers in between.
Exactly. Bare metal means there are no virtualized software layers, no shared cloud resources getting in the way or slowing things down. The client is renting the pure, unadulterated compute power of that physical machine.
Okay, let me put it this way. It's essentially like gutting a functioning but low-margin factory to build a state-of-the-art tech lab.
That is a great analogy.
Right. Because in the old crypto factory, you are paying for massive amounts of electricity to mine coins of variable value. It's unpredictable. So you are going to lose that old top-line revenue while you're tearing up the old machinery.
Yeah, but the margin profile of what you're replacing it with is completely different.
Exactly. In the bare metal tech lab, you aren't doing the actual work. You're just renting out the incredibly rare shovels, the GPUs, to desperate AI companies for a fixed premium price.
What's fascinating here is how the market completely punished the top-line revenue miss while just seemingly ignoring the margin profile of what you just described. Let's look closely at the operational specifics of that $1.1 million in AI revenue.
Yeah, let's get into the weeds there.
Well, first of all, that wasn't generated over a full 3-month quarter. That revenue was generated in just about 5 weeks, basically from mid-May to the end of June.
Wait, really?
Yeah, and they did it using an initial fleet of B200 and B300 GPUs that represents just 0.6 megawatts of deployed power capacity. Plus, management reported 100% uptime for this new segment.
Wait, generating over $1 million on just 0.6 megawatts of power in barely a month?
Yep.
I mean, that is an incredible demonstration of revenue density, but I do have to push back here for a second.
Go for it.
Is $1.1 million in 5 weeks really enough to justify ignoring a $14.4 million net loss? That just feels like a drop in the bucket compared to the cash they are burning right now.
It sounds like a drop in the bucket, sure, until you look at the adjusted EBITDA. The GAAP net loss widened to $14.4 million, yes. But you have to understand the mechanism behind that number.
You mean the accounting side of it?
Right? That loss was heavily driven by depreciation and non-cash charges. When a company buys millions of dollars of cutting-edge tech equipment, accounting rules force them to record the depreciation of that equipment as a loss over time.
Even though no actual cash is leaving the business for that expense in the current quarter?
Precisely.
Ah, okay. So when you strip those non-cash accounting charges away to see the actual operational profitability, which is what adjusted EBITDA measures, the picture changes.
Exactly. The high-margin nature of this new AI segment actually drove adjusted EBITDA to a positive $3.3 million.
Wow.
Yeah. That is a massive $3.2 million turnaround from the exact same quarter last year. That margin shift is really the core of the bull thesis here. They're trading lower quality, lower margin crypto revenue for highly predictable, high margin AI compute revenue.
Okay, I get that. But building that state-of-the-art tech lab requires an unbelievable amount of capital upfront, which brings us to the balance sheet.
Right, the fun stuff.
And honestly, this is the part of the filing that made me do a double take. If they're only bringing in $6 million a quarter, how on earth are they paying for all these highly expensive AI GPUs and data center buildouts without going bankrupt?
It is a staggering transition. DGXX ended June with $142.4 million in cash and equivalents.
That's huge.
To put that in perspective, they had a mere $1.7 million a year ago, and by mid-August, management noted on the call that their cash pile had actually reached around $150 million.
That is just wild.
And if you look at the asset side of the ledger, total assets surged to $279 million. Their net fixed assets and equipment deposits are up 447% year over year.
So they're clearly putting that money to work.
Definitely. Year to date, they've deployed roughly $110 million in capital expenditures, specifically for GPU equipment and data center construction.
And remarkably, they are doing all of this with zero long-term debt. But here's where it gets really interesting. They didn't magically find this cash in the couch cushions. The money had to come from somewhere.
Oh, absolutely.
When I looked at the share counts, the outstanding subordinate voting shares ballooned from 69.4 million at the end of 2025 to 98.5 million by June 30th, 2026.
Right.
They issued nearly 28 million new shares to raise $163 million. That is a heavy, heavy dilution of the existing shareholder base.
Is the absolute elephant in the room. They utilize the ATM or at-the-market equity program to raise that cash.
And for you listening, an ATM program basically means they aren't doing a traditional heavily publicized stock offering where they sell a massive block of shares all at once.
No, it's much quieter.
Right. Instead, they are quietly selling newly printed shares directly into the open market on a daily basis. That is why the share count slowly ballooned by 30 million shares.
Yeah.
But for the retail investor holding the stock, that dilution is brutal. It shrinks your slice of the pie. That is the true cost of this pristine balance sheet.
It is a massive cost, no doubt about it. But if we connect this to the bigger picture, we have to look at the strategic context of when management pulled that ATM lever.
Right, timing matters.
They didn't do it in a panic at the bottom. They utilized the ATM program primarily while the stock price was flying high.
Interesting.
Yeah, management actually noted on the earnings call that their last draw on the ATM was around the $7.25 to $7.50 range. That is well above the current share price of $3.97.
So they raised the capital when it was historically cheap for them to do so. They essentially sold the top to fund the build-out.
Precisely. And having zero debt and a $150 million cash-rich balance sheet isn't just for show. In the infrastructure world, having an unlevered cash-heavy balance sheet is practically a prerequisite.
A prerequisite for what, exactly?
For securing non-dilutive, asset-backed debt financing moving forward. You just cannot walk into a major investment bank asking for hundreds of millions in construction loans if your balance sheet is already choked with debt or if you have no cash reserves of your own to put skin in the game.
Okay, so you, the listener, now understand the dilution mechanism. You understand the massive cash pile, and you understand the shift in the margins.
Right.
The final piece of the puzzle is what management is actually building with all that capital, and the very real risks of them failing to execute. Because right now, they are asking investors to trust a massive vision.
They really are.
The primary growth engine they are pointing to is their Tier 3 AI data center in Columbiana, Alabama.
Yes, the Alabama campus is the absolute linchpin of their entire valuation right now. And they break it down into phases.
Okay, break that down for us.
So phase 1 represents 15 megawatts of power capacity specifically dedicated to Cerebrus systems, and that is fully funded.
Good to know.
Management confirmed that all long lead equipment has been secured, and they are firmly on track for delivery in December 2026. Then you have Phase 2, which will add another 25 megawatts. That's targeted for the end of the first quarter of 2027.
And that ties directly into the headline number that has been floating around, which is the $1.1 billion contracted AI revenue.
Yep, exactly.
That is a 10-year contract with a potential $2.5 billion option. But let's be very clear about this. That billion-dollar pipeline is entirely dependent on successfully commissioning this Alabama campus. If that facility doesn't turn on, that revenue doesn't exist.
That is the defining reality of this sector. In the infrastructure space, hyperscale customers, meaning these massive tech giants running cloud networks, they only pay for delivered power.
Makes sense.
They do not pay for press releases, they do not pay for promises, and they absolutely do not pay for delayed construction schedules. The market is very clearly waiting for the Alabama facility to officially energize in December before it will fully price in that billion-dollar contract.
So what does this all mean for retail investors reading the headlines today? You look at a $6.6 million current reality, and then you look at management's target of a $250 to $300 million annualized run rate by Q3 2027.
It's a staggering disconnect.
It really is. Is the market right to be skeptical here? I mean, they punished the stock with a 3.8% drop and a 17% intraday slide. Are they right to demand proof?
This raises an important question about how markets price in execution risk. The market is looking at the history of data center infrastructure projects, and they are notoriously complex.
Oh, for sure.
You are dealing with supply chain delays for massive cooling systems, permitting issues with local utilities, extreme cost overruns. The market is saying, prove you can build it.
So the risk isn't on the demand side.
No, not at all. The most critical near-term risk for DGXX isn't demand. The demand for AI compute is clearly there, and it's insatiable. The real risk is whether management can successfully close the syndicated debt financing they are currently discussing with Goldman Sachs.
Right. Let's clarify what syndicated debt is, because that is a key term here. Why Goldman Sachs and why syndicated?
Well, hundreds of millions of dollars data center is typically too much risk for a single bank branch to hold on its own books.
Ah, I see.
Syndicated means a major player, like Goldman Sachs, structures the primary loan, but then they parcel out pieces of that risk to a syndicate of other lenders.
That makes sense.
Having Goldman Sachs lead that facility is a massive validator of the project's viability. But if DGXX fails to secure that syndicated debt, they are in trouble.
Because if they fail to secure that debt, or if the construction timelines in Alabama slip into late 2027, what happens then?
Then the company may have no choice but to return to the ATM equity program.
Ouch.
Yeah, they would have to start selling shares into the open market again, further diluting shareholders just to keep the lights on and finish the build.
That is a really tightrope management is walking right now.
Absolutely.
Yeah.
They have the $150 million in cash to self-fund the near-term progress, but they need that Goldman Sachs debt facility to bridge the final gap to sustainable recurring revenue. And they had to do it without destroying shareholder value through another massive wave of dilution.
Yeah. Now, beyond the Alabama campus, management did provide a few other strategic updates in the filings that suggest they are trying to mature as a company.
They did, yeah.
The CTO, Jagan Jayapal, announced a new Silicon Valley office specifically to advance their GPU as a service business, getting closer to the tech hub.
Smart move.
They are also moving beyond their initial B-series hardware, noting they have ordered NVIDIA Vera Rubin systems that are slated to arrive in early Q1 2027.
Right.
But there was also a really interesting corporate structuring move regarding their subsidiary, US Data Centers, Inc., or USDC.
Yeah, DGXX reduced its ownership stake in USDC from 55% down to 48%. Now, on the surface, a parent company giving up majority control of a subsidiary sounds like a step backward.
Usually, yeah.
But the why is crucial here. They reduced their stake because USDC raised its own outside capital at a $125 million pre-revenue valuation.
Oh, okay. So by letting the subsidiary raise its own funds from external investors, Digi Power X doesn't have to fund USDC out of its own pocket. It preserves its own pristine $150 million cash pile for the core Alabama build-out and those expensive GPU purchases, while still retaining a massive 48% upside exposure to USDC's modular data center business. It's a very calculated capital allocation move.
Spot on. It sets a formal valuation marker for the subsidiary while keeping the parent company hyper-focused on its primary objective.
So to summarize all of this, DGXX's Q2 earnings report might look like a disastrous revenue miss if you only read the top line.
Right.
But underneath, it is a highly deliberate, highly capitalized, albeit heavily dilutive, pivot. They are gutting the unpredictable, low-margin crypto mining factory and spending hundreds of millions of dollars to build a highly predictable, high-margin AI infrastructure powerhouse.
The execution over the next 6 months is quite literally everything.
It really is.
It is the defining window for the company. December 2026 is the deadline that matters. The market wants to see those servers turn on.
Now, we'll leave you with a final provocative thought to mull over, which actually takes us away from Alabama.
Oh, this is interesting.
While the South is the current focus of their expansion, the earnings sources also highlight Digi Power X's operations in New York State.
Right.
Specifically, their North Tonawanda 60-megawatt site and their Buffalo 18-megawatt site. Currently, New York has an incredibly strict moratorium on new data center power expansion. You simply cannot get new power permits easily.
Nope.
But DGXX's sites are completely grandfathered in under that moratorium. So consider this. In an era where access to reliable grid power is rapidly becoming the ultimate bottleneck for the entire AI revolution, could fully permitted, grandfathered power capacity in highly regulated states eventually become more valuable than the AI chips themselves?
It's a fascinating structural advantage. I mean, everyone is focused on buying the chips, but without the power to run them, they are just expensive paperweights.
Exactly.
That grandfathered power capacity is an asset the market isn't fully appreciating yet.
Definitely something to keep an eye on as the power grid wars heat up. Remember to follow the show for daily earnings coverage as we continue to break down the numbers that actually matter.